how do you prefer to handle questions? Do you want to stop at certain times?
Whatever. I assume people have been here all week, so whatever you guys have been doing, because I assume people are used to it.
Well, different presenters have different preferences. So do you want to be interrupted whenever there is a question, or do you want to like stop yourself?
Oh, I'm happy to be. I'll pause, but I'm happy to let people ask questions as they go.
Okay.
Okay. As I go.
Sounds good.
Okay, well, I think we're live now, so I think we're about ready to start.
Okay, welcome everybody. So today, Jesse Schreger will talk to us about global capital allocation. Before we get into his presentation, I just wanted to announce that we have rescheduled Antoinette's talk to Tuesday the 17th at the same time. And so we will also send email announcements and adjustments on the website. So please, if you can join her on Tuesday, that would be great. And so JC, basically, JC is open to questions in real time. So guys, basically raise a hand or type a question in the chat box, and JC will, and I will help to facilitate Q&A so that we can answer questions in time. Okay, JC, please take it away. Thank you.
Great. So thanks so much for coming to hear about global capital allocation. So what I'm going to hope to do today is really try to give everyone a sense of how to get going to do research in international macro finance, particularly empirical international macro finance. Basically, so for global capital allocation, fundamentally, it's a question of how capital is allocated globally. So when investors move money across borders, who gets it, who provides it, which risks are shared, and which new risks are created. In the theory, there's a huge amount of literature on why it matters that there's cross-border investment. So traditionally, we think of the benefits of cross-border investment as transferring capital from savers to productive users, sharing risks, diversifying risks. There's a lot of new literature on how capital flows can determine equilibrium exchange rates, safe interest rates, and the cost of capital. There's also the question of the costs of cross-border capital flows. So particularly the idea of capital flights, crises, and the endogenous amplification of risks, and this question of unequal access to capital. This idea that global capital markets are not exactly a level playing field, and there's kind of differential barriers to entry for different actors. Now, so basically the question of how money is actually allocated across borders is going to be kind of key to this kind of host of literatures. Where the field has really been in international macro is there's kind of this large literature, particularly theoretical literature and literature using kind of aggregated data. Where we are now is that there's ever improving disaggregated data and even micro data to kind of get at these kind of key theoretical questions of why it matters, who owns what positions investors are actually taking. One thing I've noticed in my own work and also working with students is there's a big barrier to entry in getting into this field, actually in terms of figuring out how to kind of measure these things in the aggregate. And so what I'm going to do today is I'm going to go through, there's kind of 4 sections here. I'm going to begin with just a very quick overview of balance of payments, how you account for capital flowing across border and a country's kind of net foreign asset position. Then what I'm going to do is really go through how one starts a project in kind of empirical international macro finance when the goal is really to understand how capital is flowing across borders. And so that's really about how we're going to measure the concepts we care about in kind of publicly available macro data. Because no matter what, when using kind of disaggregated or micro data sets, the starting point is always going to be kind of these aggregate patterns for kind of the international macro payoff. And so what I'm going to talk about is how once you've kind of measured concepts that you care about in the aggregate data, how you can then use kind of newly available financial market data and micro data to kind of look under the hood of what's actually kind of driving these key patterns. What are the kind of mechanisms behind the theory? And I'm going to kind of focus on two in my talk today. The real importance of currency in international portfolios, and kind of what I think is a big and growing question: how the use of tax havens and offshore centers distort our understanding of who is allocated, who is actually receiving capital around the world. So let me jump into kind of an introduction to kind of international macro accounting. So the kind of key variable that we care about in international macros is a country's net foreign asset position. How much a country owns abroad, so a country's foreign assets, relative to its foreign liabilities. And so if you think of kind of what is a foreign asset from the perspective of the United States, if the United States or citizens in the US own Japanese equities, that is a foreign asset of the United States. What is a foreign liability of the United States? Let's say the Chinese Central Bank, the PBOC, owns a bunch of US Treasuries. That could be the US foreign liabilities. Now, the key here is that this net foreign asset position, the difference between a country's assets and liabilities, is not a measure of wealth. That the United States can be very wealthy by owning its own stocks, but instead it's really a measure about how much a country owes the rest of the world, and that's really going to make this net foreign asset position a key driver of macroeconomic dynamics. And the reason is, if you have a large net claim on the rest of the world, it essentially entitles you to future current account deficits. That basically you can import more than you export, potentially running down these savings. And so if a country's current account is less than zero, it generally means that its net imports are negative. So it's running a trade deficit. There are other components of the current account, in particular, net factor income and unilateral transfers. But really, the current account and the trade balance are going to be intimately linked. Now, what are the dynamics of a country's net foreign asset position? So a country's net foreign asset position, as I said, is just its assets minus its liabilities. But you can essentially split. Yes.
Sorry to interrupt. I'm worried you're still the title slide. Maybe they're not switching.
They are not switching at all.
They weren't switching. So
so then let me show you
the title slide.
Then let me go through here and say, actually, so this slide was fine with you just seeing the title slide. Let me walk through what the law of motion for a country's net foreign asset position is. So a country's net foreign asset position is, it's essentially net claims on the rest of the world. It's assets, foreign assets minus its foreign liabilities. So in the example of the United States, I'd said assets could be Japanese equities, liabilities could be Chinese holdings of US Treasuries. Now, how is that going to change over time? So you can write a country's NFA as simply its as assets last period minus liabilities last period plus two terms. So in particular, the current account balance. So this is saying if you export more than you import, you want to think of that as you're selling more than you're buying. What are you getting in exchange for that? You're getting a new net position on the rest of the world. Now, in international macro, for decades, we really kind of focused on, this is the driver of changes in a country's net foreign asset position. You sell more than you buy, you run a current account surplus, you accumulate assets. What's been a real focus of the last few decades in the field has been this final term, valuation changes. As a country's gross positions has gotten larger, that not only do you have more assets, you also have more liabilities. Small movements in the return differentials on your assets minus your liabilities can have huge valuation effects on a country's net foreign asset position. Now, one of the things to be careful about when measuring this is that it's actually very hard to separate these two in practice because of essentially adjustments that are made over time. So there's a fantastic paper by Kakuru, Thomas, and Warnock talks about kind of how to do this. But just to kind of go back to conceptually why we would care. if a country has a big negative net foreign asset position, what that's going to mean is that it essentially has it's either going to have positive trade balances, that the reason you have a lot of net foreign assets is so you can essentially buy more stuff later, or you can have positive net factor income, or positive, you can essentially send transfers abroad, or sorry, receive transfers from abroad. Or instead of actually having current account surpluses or deficits, what you're going to have is valuation effects on your position. So essentially, yes, at the present, you have a negative net foreign asset position, but if your assets pay off more than your liabilities, then you may not actually have to adjust on the real side, or it could be some combination of both. Let me make this a bit more concrete. So who are the countries that in the world that are kind of the largest debtors and creditors? So just in levels, no surprise, kind of the country with the most negative net foreign asset position is the United States. So the kind of largest international creditor, more liabilities than assets. The largest creditor is Japan over here. Now, if we scale this in terms of a country's GDP, the largest creditor is Norway, with a kind of giant sovereign wealth fund that the country invests, on the proceeds of its oil revenue, with the big debtors being kind of Ireland and Greece. Okay. Now, let's talk a little bit about, just to give you a sense of kind of why the the international finance side of international macro and this kind of this growth of cross-border positions has been emphasized so much, by looking at the kind of dynamics of the United States net foreign asset position over time. And so here, this is plotting the US NFA, how much the US owes the rest of the world on a net basis over time. And so you can see to around 2008, it was actually around 25 to 30% of GDP. If all you had done was accumulated the United States current account deficit, what you would have expected is that the United States owed the rest of the world around 50% of GDP, because every single year the United States was exporting less than it imported, and so you would expect it to borrow. Now, how could it be that the US had an NFA that was so much less negative than its accumulated current account? Well, the valuation effects went massively in the other direction. And so what this is basically saying is that, yes, the US was selling less than it was buying from the rest of the world, but on its portfolio, it was earning such a much higher return than it was paying on its liabilities. So this kind of the seminal Grinchas and Ray International Financial Adjustment paper, you could really emphasize kind of two channels. The question of, is it because the US was kind of investing in riskier stuff? Picture equity and foreign direct investment, which I'll talk about. And it was really borrowing using US Treasuries. And so, this way, even though the US was essentially every period borrowing, because it was earning these high returns, its net foreign asset position didn't deteriorate. And this was really emphasized as the exorbitant privilege over decades. Now, something has changed pretty dramatically over the last decade. And this is actually something that's the focus of a really interesting new paper by Atkinson, Heathcote, and Perry, that they're calling essentially the end of privilege, that over the last decade, everything has gone the other way, that the US current account deficits have actually shrunk. So the US is, has not been borrowing as much internationally, yet at the same time, the NFA has deteriorated massively. That essentially without large current account deficits, the US now essentially owes the rest of the world nearly 60% of GDP. And the reason here is essentially that the valuation effects have now moved dramatically against the United States. In practice, what does this mean? It really means that essentially US liabilities have paid off way better than US assets. And so the focus of the Atkinson and co-author papers is that what's happened is that US equities have essentially outperformed, and that alone can drive the current account. So for our purposes, though, and please do jump in at any time for questions. I'll take a pause, but and all of this stuff, anything big or small, please do.
Jesse, I have a quick question. Just about the last thing you said. Why did you say because US equities outperformed? I didn't.
Sure. So okay, so this is great. So basically, if you want to think of what is actually going to drive valuation effects moving against the United States, okay? The liabilities of the US, some of them are foreigners owning, let's say just a claim on the S&P, okay? American assets are Americans owning a claim on the rest of the world's stock markets. If the S&P performs really, really well, that means that the claims that foreigners have on the United States increase more rapidly than the US has on the rest of the world. And so one of the things that can actually deteriorate your net foreign asset position is excess returns on the assets produced in your countries that foreigners own. And so it was always emphasized in the previous period, why is it that the US NFA can be so much smaller than the accumulated current account? US is going to earn high returns on equities and pay low returns on treasuries, right? But the positions of foreigners in US equities is quite large, as Atkinson and co-authors have emphasized. And over the last decade, what you've seen is this massive outperformance of the US stock market, is their argument. And so what that's going to mean is that essentially foreigners' positions are going to mechanically grow with the size of their claims in the US. Does that make sense?
So, yeah, sure. So between 2000 and 2010, this is just the stock market was basically, we know the stock market had a 0 average return, and that's what you're seeing here. It does give a very different interpretation. Like if you're focused on this as there's the constant current account, negative current account is bad. This makes it look like not so bad, but actually it's because we had a terrible decade in the stock market. So
it depends.
Careful with interpretation here.
I think so. And in addition, I think that there's a big question now in my mind from the recent deterioration of the US NFA is how you really think of a country being special and earning a privilege, okay? So if you look at the arguments for why the US was special for decades, okay, over here, it was everybody wants treasuries. So when the US borrows, it delivers the world a safe asset. Going to pay low returns, right? For a lot of the reasons we think about. You provide safety. You have a no risk premium, you have a negative risk premium, and so your liabilities will pay very, very little. The U.S. is going to invest in equity. You just want to think of it in terms of expected risk premium. The U.S. is earning the equity risk premium on its assets, but it's not paying the equity risk premium on its liabilities. And in fact, it may pay a negative risk premium because it's providing safety. Now, that's very different than the story in this period, where the valuation effects are driven by equity. And in my mind, it's very hard to kind of get a sense of, is this a change in, if you think of the exorbitant privilege as persistent differences in expected returns versus realized returns. And so, whether going forward, it's reasonable for us to expect the U.S. to pay less going forward. And this was, this period was, one draw. I think is kind of the big open question, because what you do see is large heterogeneity large differences in the composition of the U.S. external assets and liabilities. And so, the U.S. is funding itself with debt and it is investing in equity. And so if you think the equity risk premium still exists, there's still plenty of reasons to think, just because of the differences across asset classes, the U.S. would pay a lower return. But the recent story emphasized by Atkinson and co-authors is actually within that asset class difference in returns. That of the component of portfolio equity, there's been a differential return. And I agree that has very different impacts for what you think of like welfare.
Yeah, just very quickly, I don't want to like hog all the time.
No.
But so well, the reason it's a little funny is because in a sense, suppose the stock market's a reflection of how well the country's doing. That's a debatable, but let's just say it is. Then it's like, well, we did horrible from 2000 to 2010, and in a sense, we're poor. But on the bright side, we beat out on net the other countries because they invested in our terrible stock market. So that's like, that's the sense in which it's not, it looks good, but actually it's a reflection of just how badly you did. And because you're getting poorer, so then their claim on you isn't worth much. Here, this decade, you could say, well, we did great and we're all feeling rich, but as a result, we end up owing more to outsiders, but we can pay more because we're richer. So I understand that's a simplification of it. It was just kind of the flip side.
No, but it's a great point. And to be honest, though, the reverse happens all the time. That how do a lot of emerging markets narrow their negative net foreign asset position and bring it to zero? They default on their sovereign debt. So in some sense, generally speaking, there are ways that narrowing the net foreign asset position can be accomplished in many different ways, and it's not necessarily that more negative means you're doing worse or you're poor. It is quite U.S. wealth, domestic, and this is actually the key where I wanted to emphasize the NFA is not wealth. The U.S. now, foreigners have a larger position on the United States, but U.S. wealth increased with the stock market too. And so it's not as if that's a one-way thing. Tyler?
Yeah.
Oh, sorry.
Oh, well, I just had a question, Jesse, about in the hypothetical you were discussing about Itamar with the investing in the stock market versus foreigners investing in U.S. Treasuries. Is that truly the compensation of the debt that the United States owes? Is it all in the form of Treasuries, or is it some of it in the form of equity?
So, no. I'll actually show you this in a few slides. So I'll come back and show you exactly the disaggregated U.S. Balance sheet. The U.S. has a larger share of its external liabilities in government securities than other countries, and the reason for that is, as the global reserve currency, or I'll actually show you. As the global reserve currency, when most central banks around the world own a safe asset and they, put it away as their foreign exchange reserves, it tends to be a U.S. Treasury, and so that's going to mean that the liabilities of the U.S. Are more tilted towards, cheap government, low yield government bonds than for other countries. Now, in terms of what's going to matter for these dynamics and this discussion of what can drive the NFA, once you think of the drivers of the NFA as valuation effects, it's really going to matter how a country finances itself and how it invests abroad. And so generally speaking, assets and liabilities can be classified into 4 categories. I should have said 5 because actually, foreign exchange reserves on the asset side are technically going to be a different one. But basically, you can split a country's external balance sheet into these categories. So portfolio investment is stocks and bonds. So these are traded securities. Other investment is kind of has a mix. The predominant one and the one I'm going to focus on is bank loans. So this is just a component of other, but it also includes direct holding of currency, trade credit, and other components. Foreign direct investment is, well, I wrote here, think about control and ownership. It's generally thought to be essentially when you take a controlling interest in a firm. So the threshold is, it varies by country and time, but you want to think of, you have a large enough equity stake to control it, to control an entity, you build a factory, you take a large stake in a foreign company, that's going to be foreign direct investment. Now, why does this tend to matter for dynamics? So what we talked about is portfolio investment stocks are essentially going to, the valuation effects are going to move with the index unless, foreigners own a selected subset of securities. But basically, as the foreign stock market moves, your stock market moves, the valuation effects are going to move 1-to-1. Portfolio investment bonds, because they're always denominated in a particular currency, movements in the exchange rate are going to mechanically lead to valuation effects. And so one of the things that Rinchas and Ray emphasized is that if the one of the ways in which a country's net foreign asset position could adjust is a large negative net foreign asset position should predict an exchange rate depreciation, because essentially depreciating the currency is one way in which you're going to reduce the value of your liabilities more than your assets and essentially close that NFA. in terms of FDI, foreign direct investment tends to be what countries tend to want to attract, because there's this sense that foreigners are flighty. So basically, a lot of capital flight episodes and foreigners panicking, you tend to think of them selling the things that they can liquidate fast. And so portfolio investment, and to a lesser extent, bank loans, would be referred to as hot money. Countries really want to get foreign direct investment because you think if you have foreigners building a factory in your country, if some bad news comes out and they panic, they might find it much harder to sell and get out. One of the things I'm going to emphasize a lot when we're kind of digging into the data is that these distinctions are actually harder and harder to measure. And I think there's a lot of important research to be done on this. So any questions here before I turn into how you'd actually go about measuring this stuff? All right. So a lot of the questions, as I mentioned before, a lot of questions in international finance and macro are all about this question of who owns what. And so to really dig into this, I would kind of suggest, at least what I always do and find useful when thinking of how to kind of bring new microdata to bear on questions in international macro. The starting point is always the aggregate data, and essentially how you can use the aggregate data to figure out the broad patterns going on. And so what I'm going to do is, so whenever you look at aggregate data, the starting point is always going to be the IMF balance of payments and international investment statistics. And so basically, the BOP, as it would always be abbreviated, it's essentially, so this is going to be the quarterly current account matched with the financial account. So the financial account is essentially going to be broken into, in a given quarter, how much a country has purchased on a net basis of foreign stocks and bonds, portfolio investment, how much other investment they've made, how much FDI they've done, how much derivatives they've purchased, and reserves. And so the BOP is the flow component. The IIP is the stock, and it's supposed to be at market value. So this is at the end of a given quarter. What is the aggregate claim of a country on the rest of the world by kind of this asset class, and what does the rest of the world own in a country at that asset class? Now, one of the things that is important to know about this kind of aggregate data is that it's always multilateral. And so what you can observe in the IMF and the balance of payments international investment position data is you can know how much the US owns abroad or the rest of the world owns in the US, but you can't ask, and a lot of countries are now disaggregating this very, very helpfully in a way that you might be able to know, so Brazil does a great job of this, you can see how much, foreigners own in, portfolio debt securities issued, in Brazil, and, fine cuts. But fundamentally, it's always just foreigners versus you, okay? Now, where there's a lot of really interesting progress going on from the IMF and the BIS is essentially disaggregating this macro data into bilateral data sets. So how much the US invests in Brazil, China, everywhere around the world, essentially by asset class. And these, to me, are the cuts that, if you think of doing. So I looked at David Thesmar's excellent, talk earlier this week in the summer school, talking about how you can use kind of microdata for macro questions. Kind of when you do this in international macro, one of the questions, if you actually get your hands on kind of a micro data set, is how do I know how much of a country's actual position this data is going to cover? I'm going to talk about this in the context of my own work using mutual fund data. But when you actually want to use this kind of financial market data for international macro questions, what you really turn to are these kind of aggregate data sets to know two things. First, how representative is my data of these kind of cross-border aggregates? And then something else I think is important, how important is the component of a cross-border position that I can measure for a country? And both of those are going to be very important things when you consider doing your own research in this field of knowing, it's not just about kind of getting interesting microdata, it's figuring out, does it cover what I need it to cover? And am I measuring something that's important? So let me kind of show you how you kind of begin seeing those things when working in this area. So this aggregated is the United States international investment position. So the asset sides is in blue, the liabilities are in red. And so, and then the NFA, plotted again in the series we saw, is in black here. And so immediately what you can see is that, really since the 90s and elevating a lot during the 2000s, is this massive rise in the gross positions, that assets have grown and liabilities have grown. And so what does that mean? It means that these relative valuation effects can have a much larger movement on a country's NFA because the positions in both directions have gotten so much bigger. Now, in this IIP data, you can further split it. And so you can really get a sense of how the US invests abroad on the asset side versus how it borrows on the liability side. And in fact, you can further split this. And I think this is actually getting to kind of the substance of what we were talking about before. So on the liability side, you can see this is what foreigners own in the US. This orange here is portfolio debt. So portfolio debt is bonds. This is foreigners owning US Treasuries and US corporate bonds. That tends to be a relatively cheap way for the US to borrow. Contrast that with the asset side of the US balance sheet, where it owns significantly less portfolio debt. And so you can immediately see that just on the bond side, the US is financing itself a lot more through debt securities. And instead, its investment is more concentrated in stocks and foreign direct investment. And so this is kind of underlying this idea of return differentials. The components of the US balance of payments, international investment position, are very, very different. That the US is financing itself with bonds, but is investing in equity, and we should kind of expect it to earn this equity risk premium. Now, other countries look very, very different than the United States, and so this is just how different Brazil's international investment position would look. So you can even kind of see on the asset side for Brazil, one of the largest components is foreign exchange reserves. So what does Brazil own? It owns a giant pool of US Treasuries sitting at the central bank, for exchange rate management and things like that. In the US figure, you can't even see it. There's a little bit of gold, but that line doesn't even exist. And when you zoom in on Brazil's position, if you look at the asset side of Brazil's balance sheet, it essentially doesn't own foreign stocks and bonds. It's simply not how it's investing. So in terms of what could move the relative valuation effects of Brazil's position, it's not going to be excess returns in US equities. It's just too small. You contrast that of how Brazil really finances itself. It's going to get just a ton of foreign direct investment. And so immediately, if you want to think of kind of what are and it's also going to get portfolio investment. And a little bit of other is all going to be bank loans. And so this is the sense in which just looking at the aggregate data, you can already immediately see huge differences in how countries borrow and lend abroad. So now let me kind of zoom in on if you wanted to understand what was going on at a more disaggregated level, how you would do this. And so I'm going to go through kind of the primary data sets, public data sets that I would suggest using in international macro by these different components. Ju Young?
Yes, this is Ju Young speaking, and I've got a question for the previous slide. The first question is whether we can generalize it into a typical developing country, and the other question is for the liability side, it got much of portfolio. I wonder whether large of this portion comes from stock, stock market or bond market.
So great questions. So yes, I think that you can generalize this pattern quite a bit for other emerging markets. In particular, this rise of reserves. So I wanted to plot the disaggregated balance of payments. So you'll notice I started at 2000. Basically, the closer you get to the present for many emerging markets, the more you can split it. But basically, after the Asian financial crisis in the late 90s, where emerging markets saw huge capital outflows and attacks on their exchange rates, there was a trend towards emerging markets accumulating large exchange reserves. So this is what you'd see in China, South Korea during the post period. Portfolio in Brazil is actually going to be both stocks and bonds. That's generally typical. The components within stocks and bonds, I should have plotted it here, actually change quite a bit. In Brazil, there's differential policy changes. So Brazil in around 2010 introduced capital controls on holdings of various portfolio securities, so in particular local currency bonds, that changed the composition. One of the things I'm actually going to emphasize, so I'll have a slide a little bit farther on, is this foreign direct investment component is actually going to mean very, very different things by country. And I think that this is actually kind of a big element for research, because one of the things I'm going to talk about and show how you can measure is that FDI can be FDI equity or FDI debt. And a lot of what's actually occurring in many large emerging markets, Brazil in particular, is that what's called foreign direct investment is actually a lot of it is going to be portfolio bond investment intermediated through tax havens to get money into the country. And so I'll kind of show how you can kind of dig in and see basically. So what I'm going to actually, one of the reasons to dig into the disaggregated data is how to really get a sense of how to interpret these aggregates, when to know whether you should treat them in a straightforward way or adjust them. But I think that'll be clear kind of going forward. Does that get your question though?
Yes, thank you.
Great. So if you wanted to dig into, if you really wanted to understand what, so this is for the United States, if you really wanted to understand what's going on in the portfolio investment position, where do you turn? And so the data sets I would recommend that you turn to for holding data are, there's really four. Public ones, and then I'm going to talk about how, in the second part of today, I'm going to talk about how you can use mutual fund data to essentially, get underneath this, because a lot of the cross-border investments are actually intermediated through investment funds, and so exactly the same data that finance has been using for a ton of questions, fund manager skill, return chasing, everything, not to undermine it, everything in this large literature can actually be used to kind of look under the hood of all of these data sets. But the four I really want to talk about here are, so the IMF Coordinated Portfolio Investment Survey and the US TIC data I'm going to talk about. The one I'm not going to talk about a lot is the ECB Security Holding Statistics, which is a really fantastic data set that research has been using at the ECB. It's basically going to be where European investors by sector put their money around the world. But let me actually show you what one can do with these different data sets. So this is kind of the page of the IMF Coordinated Portfolio Investment Survey. They're going to have various tables. The kind of key one is the table one, the reported portfolio investment assets by economy of non-resident issuer. So what that basically means is you can open up a file that says, where does the US invest by country? That's what it's going to say. And so there, unlike the BOP and IIP data, you can actually know where the money is going. Now, one of the challenges though is, so there are more, finer splits. So for instance, table 2 will have the currency of where it's invested, but that doesn't have kind of bilateral. So you can say, hey, the US is buying euros, but you can't say which country they're buying them in. And so, the core table is going to be 1, and there's, recent enhancements, but they're not yet as complete as the fantastic stuff in table 1. But let me give you a sense of what I mean by you can use this to decompose a country's external position. So the first step is just to do kind of a sanity check of, if you kind of open up this IMF Coordinated Portfolio Investment Survey, or I should say, what they basically, let me step back for a second. what this does is goes to every country around the world, and it basically to their government, and it basically does a survey of where, what are the claims that your residents have on the rest of the world? What's the location of them? Now, the goal should be that this is going to exactly decompose, a country's international investment position in the IMF balance of payment data. So if you look at how much the US owns abroad, you should be able to split this into where the money goes in CPIS. And so here I just did a kind of quick sanity check of taking, so this is for the US, in green, this is how much the official data says the US owns of foreign stocks around the world. In orange is if you sum up how much the US owns in every single country in CPIS. And so they're nearly the same series. And so this is how you can actually zoom in. For bonds, it's nearly there. But so the kind of thing you can do in the CPIS data is you can now look at where is the US actually investing in terms of stocks and bonds around the world. And so if you look at equities, what you'll see is a few things. So I've actually split this data into countries I've classified as non-tax havens versus tax havens. And so you'll immediately see one of the big challenges of working with international data is when you open this up, the first country you see that the United States has a large equity position in is the Cayman Islands. Nobody lives in the Cayman Islands. It's essentially a tax haven. And so immediately what you see is the US owns $1.4 trillion of equities in the Caymans. You'll also see huge investment in Ireland, Bermuda, Jersey. And you see something similar on the bond side, that the positions are again in the Caymans, the Netherlands, Ireland, and Luxembourg. And so one of the big challenges here is knowing how much this growing use of tax havens is going to distort the bilateral data. And so one of the things I'm going to our understanding of where money goes. So one of the things I'm going to show how you'd measure and how you'd actually adjust this data is that this Cayman Islands position in equity is fundamentally going to China. And so if you were to just take the official data and look at it, what you would say is that the US position in China is smaller than the position in Taiwan. But in fact, it's that the way these statistics work, everything that, almost a huge amount of the investment in the Caymans should actually be classified as going to China. And so I'll talk about that. Now, for some countries, you can then go a little bit farther. Like this, for the US, is the most disaggregated you could really get in the CPIS data, which is already tremendously valuable. And so this is kind of underlying the huge literature on gravity. And so Portis and Ray and many papers that follow basically are going to look at what are the determinants of where countries invest around the world. One of the arguments is that so if you ignore the tax havens for now, which most literature does, it really looks like gravity in international trade, meaning where the position is going to be larger, you're going to invest in countries closer to you. So the US is always going to have a big position in Canada, and it's always going to invest in larger countries. So no surprise, it'll be invested in Japan. So already you have kind of this is every 6 months, bilateral for every single country. This is already an incredibly useful resource for knowing where investment occurs. But you can't split it any farther. For the US, you actually can. So you can go to the so-called US Treasury International Capital data. And this is actually the same data underlying CPIS, but the US actually disaggregates it even further. And so the type of stuff you can do for the US is you can actually split, not just, so this is an example for bond investment. You no longer just see what countries the US invests in. You can say, for each country, what currency do they invest in? You can actually split this by corporate and sovereign. And so you can here, using the tick data, and I think this is a tremendously underutilized resource in the field, you can really look at a fairly disaggregated portrait of where the US is sending money around the world. There. The other aggregate resource I want to highlight, so this is at the BIS, Hyun Shin and his team there are just constantly kind of improving this and kind of all the resources there. But the BIS International Debt Statistics, this isn't about bilateral data, so you're not going to know who owns what, but you're going to get a sense of how different countries borrow internationally. And what's great about this is going to have more disaggregation at the country quarter level about who's actually issuing debt. And so they're going to split the issuing sector into whether it's a bank, you do non-financial corporates or the government, you can split it by currency and maturity, and there's going to be many different cuts of the data available. But one thing to flag here is that this is a kind of data set that isn't designed to be reconciled with international statistics, because this is all about how much a country borrows in international capital markets. CPIS and the balance of payments is all about how much a country owes. And so fundamentally, if foreigners are buying domestic debt, so let's say any Canadian household buys a US Treasury, that's not something that's going to show up in this BIS data, because the US didn't issue it on international capital markets, it issued it domestically. And so there's going to be big heterogeneity in whether or not this this issuance data can recover the international investment position data. And so if you look at the US, international debt securities are way under the international investment position. And that's because the US firms and government issue their debt domestically and foreigners buy it. Contrast that with a country like Chile, where the two series are almost exactly the same. Now, how could this be? This is all about what foreigners own that's issued by any Chilean entity. This is all about how much Chilean entities borrowed on international capital markets. If the only thing foreigners buy of a country is what's issued internationally, these are going to be the same, and you can then use it to decompose. But for other countries, it's going to be a very different measure. Okay.
JC, there's a question.
Oh, please.
From Sanjay.
Oh, please jump in.
Sanjay, go ahead.
Oh, hi. So do we have an external country-wise decomposition of investment in US equity and bonds like we had for US and other countries?
Absolutely, great question. So if you turn to in the TIC data, table 8, what they do is they basically flip it. They basically take, so it's always reported on the asset holder side for CPIS, but you can just look at it from which countries invest in which other countries. So you can immediately see who's investing in the United States. In the TIC data, they have two separate reports. They will have annual foreign holders of US securities, so that's the liability side, and I was highlighting annual holdings of US foreign securities, the asset side. So yes, you can get both.
Oh, perfect. Thank you.
Mm-hmm. Now, let me turn to the kind of next component of where you'd go for if you wanted to look at bank lending. I'll do this here a little bit quicker here. So once again, the BIS is the place to go here. They have these two fantastic data sets on the locational banking statistics, the locational banking statistics and the consolidated banking statistics. So basically, you can make precisely this graph here. For some reason, I must have left it out here. But you can make exactly that type of graph using the BIS locational banking statistics and the consolidated banking statistics. It's basically bilaterally, where does every country lend to? Where do their banks lend around the world? It's going to be, so I've included here from Hyun Shin, Stefan Adjiev, and Wooldridge, basically this fantastic guide to the BIS locational banking statistics. And they've started making it available to researchers more disaggregated. So they have a fellowship for PhD students to visit. It's really a fantastic resource. They have two different measures of this. I'm going to talk a lot more about this residency versus nationality basis, but let me explain what this is. What the residency basis is in international is it's basically ascribing a location to immediately where an investment occurs. Okay, so imagine that JP Morgan has a subsidiary in the UK, and that subsidiary lends to Germany. Okay, so on a residency basis, that would be a loan from the UK to Germany. Okay, and so the locational banking statistics are residency by bank. The consolidated statistics are going to say, let's actually ascribe the location of where a loan is made to the headquarters of the bank. So if it's a JP Morgan subsidiary making a loan via the UK, The consolidated banking statistics are going to actually describe that to the loan being made from the United States to Germany. Okay. And so that's really going to be kind of the, and what's very convenient about this is they're getting more and more disaggregated splits from their, from this locational banking statistic data. Now, the other big component of cross-border investment that is significantly harder to get is good data on is foreign direct investment. And so here, I kind of previewed this, but here I split for the US foreign direct investment into FDI equity and FDI debt. So whenever we talk about FDI casually, we're always talking about the blue part, that foreign direct investment is about getting control. But there's another category, foreign direct investment debt, that is essentially intercompany loans. So if you have a subsidiary that's making a loan to you. Now, this tends to be very, very small for most countries. But for some emerging markets like Brazil, this can actually be a huge part of how the country finances itself. And so for Brazil, what you can immediately see is that this FDI debt is a pretty big component of how Brazil borrows. And so one of the things that I'm going to show you how you would kind of unwind is that this FDI debt is all about, or a lot of it is about kind of the use of tax havens. I'll show how that works a little bit later. But before doing that, let me kind of flag a few.
Jason, sorry, there's a question from
Oh, sorry, please.
Yeah, please go ahead.
Yes.
So hi, I wasn't really sure how to ask this question, but when you're looking at the BIS data, I'm not sure that it, like, how do you make sure that you're technically using it? Based on, the example with the London firm making a loan to somewhere else, to me, that, how do you make sure that it's not, like, it would go into the US balance of payments and not
Absolutely.
the UK? I know that that's a deeply detailed issue, but it's sort of like, do you have an idea of like, to make sure that you do that correctly?
Yes, so this is important. So everything about the balance of payments is about when money leaves your country. And so everything in the IIP is going to be on a so-called residency basis. And so immediately, any entity in the US putting money, any entity outside of the border, that is where the balance of payments in the international investment position works, okay? And so if you're trying to reconcile the BIS international, I forgot, I didn't have the locational banking statistics, or actually the same works with the portfolio data. If you wanted to reconcile the issuance data with an international investment position, you always use residency. And the reason for this is that, so I'll talk a lot about, so let me give you an example of nationality and where it's going to matter, just to preview. Toyota Motors North America, okay? Subsidiary of Toyota Japan. It's going to be issuing in the United States. For the perspective of the balance of payments, when an American buys a bond issued by Toyota Motors North America, no money has left the country. It's an American entity borrowing from an American resident. That's how the international statistics are going to capture it. If you want to say that's a loan to a Japanese car company on the nationality basis, you're going to be ascribing a flow to Japan that would not be necessarily recorded in the BOP. And so all of the BIS data is, and so I should say, this is actually so the BIS international debt statistics has a residency and nationality restatement by the borrower. The BIS locational and consolidated banking statistics do it on the lender side. And so what's the difference of that? It's going to be about whether or not the entity borrowing is based in your country or a foreign country. But I promise I'll actually, if this is unclear, the last part of today is all going to be going through that. So please do flag me if anything there is not clear at all.
Thank you.
So just to kind of flag a few great resources for where to go. The IMF has the Coordinated Direct Investment Survey here. It has the IMF Coordinated Direct Investment Survey. I included a link. I'll show you here. You can basically make the exact same bilateral plots. If you this is basically asking the question of, on a bilateral basis, where does the United States make foreign direct investment? One of the massive challenges, though, and so the left is equity, the right is debt. One of the massive challenges, and this is why this residency, nationality, and tax havens, it seems like at first, and at least when I started working on this, it seemed like it had to be these like minor technical issues of, is this really going to change things? And the answer is yes. So if you look at where the US makes foreign direct investment, it is the Netherlands, Great Britain, Luxembourg, Ireland, Bermuda. So you have Canada down here, then you have the Cayman Islands, Singapore. All of this FDI is intermediated through these offshore centers. And so the challenge is really to figure out where the money is actually going. So there's a really nice resource by Damgaard et al. They've essentially tried to reallocate the IMF CDIS of where it actually goes when you kind of look through these tax havens. And so I'd really recommend that if you're looking at the IMF Coordinated Direct Investment Survey, to also kind of take a look there. And the BEA has fantastic data, but that's going to cover the United States. And so that's really what I wanted to say about measuring aggregate, how you actually do measurement in the aggregate. And any questions here, I can turn to basically how you use microdata to kind of go a little bit further. Great. So that's really how I think of, when you want to, if you have an idea in international finance, international macro finance, and you have an idea of what's big and what's small, those are that's really how I would get started on a project. What I now want to turn to is how we can use microdata to kind of get at the mechanisms and the drivers kind of underlying these aggregate patterns, and potentially look through some of these kind of issues with international statistics I've highlighted. Okay. So taking a finance perspective, where should money go around the world? When I say should, it's, if you take the simplest model, where should people invest? So if you take the kind of frictionless benchmark of a world CAPM, you basically think, we all hold a safe asset and the world portfolio of risky assets. So everyone's going to hold every market in proportion to its size. Okay. Now, some assets are not going to be traded. So like my future labor income. So I'm going to want to tilt assets towards things that are negatively correlated with my risk. So, at a country level, for the exact same reasons we would think you don't want to hold equity in your own firm, that would be really a reason why you don't want to hold equity in your own country. That if basically if you think your aggregate labor income loads on how your country is doing economically, and your assets covary with your the economic conditions in your country, you should want to buy foreign stuff that's less concentrated in you. But what immediately jumps out is just how far we are from this benchmark. And so this is kind of a classic empirical finding. So this starts with French and Paterba, 1991 on home bias, and just thousands of papers to follow. But the world looks nothing like this. And so here I've measured this idea of home bias. What this is it's 1 minus the share of foreign securities in your holdings. So of all of my holdings, how much is in the rest of the world? And you divide that just by how much foreign securities are in the global portfolio. Okay. So if I'm following the CAPM and I'm owning every single asset in proportion, the numerator is going to be 1, The denominator is going to be 1, and so this is going to be 0, okay? I started all of these graphs at 0.4, and so some of them even, and so let me actually do the other thing. If you own 0 foreign securities, this is, home bias is going to be bounded by 1. And so what I've plotted here over time, this is using the CPIS data, the extent to which countries are biased. And so you do see some changes over time. So in particular, the Euro area has seen a big decline in home bias. You've seen a lot for the UK and some for the US. For many emerging markets, and this is actually coming back to that graph I made of Brazil, saying Brazil doesn't own any portfolio securities abroad. If Brazil doesn't really own any portfolio securities abroad, it's essentially going to be entirely home bias. The only equities it's going to own are Brazilian equities. And you see something fairly similar for South Africa. So people are tremendously overweight their own countries. There's actually an even more extreme pattern for bonds and less of a decline. And so you can see across the board, investors around the world are just going to overwhelmingly invest in securities issued by entities in their own country. So essentially, nobody is diversifying away their foreign risk. Okay.
So Jesse, could it be related to ease of trading foreign securities in different countries?
Yes, I think that there's a lot of, so there's a ton of explanations here. So one is ease of trade. The ease of trade one does have to confront the fact that, so this is stagnated, right? So I think that things have gotten so much easier to trade. But I think that clearly that's going to be one of the things that has driven it down. In terms of ease of trade for many emerging markets where there's capital controls, definitely. The other types of stories are kind of information and other frictions, but fundamentally, yes, I think that would be one of the things that drives it. And so basically, you want to think the stories kind of trying to explain this are, on the equity side, are some are saying there's some nice papers explaining that the simple statement I made here is wrong, and that actually domestic equities are a better hedge for labor income than you would think. The others, Simon van Nieuwenburg and Laura Veldkamp, are emphasizing information that basically, domestic, you're much more informed about domestic securities. You essentially treat them as if they have a lower perceived variance, and that's going to move your optimal portfolio depending on where you are. To your story, essentially, if you think of any frictions, if you think that the gains of diversification aren't enormous, it wouldn't take that large of frictions like ease of trading to generate this. On the bond side, which is what I'm going to focus on, I think you can actually go a little bit farther. And this is actually where, I'm going to focus here, that I think that what's going to be very convenient here when you, and this is an example of where you have microdata of at least my answer to why don't foreigners own, why do people not own foreign bonds? Overwhelmingly, the answer is going to be that people don't take on currency risk, that people are overwhelmingly only going to lend in their own currency. And one of the things that you essentially, this is kind of an example of something you can't see in the aggregate data, that in fact, when people are lending abroad, they're going to overwhelmingly do it in their own currency. That's the type of thing that you're going to be able to see when you look into the microdata. Something as simple as a country investing abroad in every other country, what currency do they buy a security in by country? That's the sense in which you already need to really turn to the microdata. And so, but Mike, I don't know if that gets at what you're thinking.
Yeah. So I just have one more question of clarification. Yeah. So if you could go back to that, because I find this figure striking. So the reason I find it striking is that the cross-sectional patterns and cross-asset patterns are different. So it should tell us something exactly, because there are all these different stories. But then if there is an information story, for example, when we look at equity, somehow we have to say that people who are sitting in the UK or the Euro area somehow have tremendously better information about US stocks as opposed to people sitting in Brazil. maybe it's true, but we can somehow we have to tell the story. That's why I brought up ease of trading, because like I know, having lived in the UK, I know that they're basically pushing foreign investments through through retirement funds, right? So like a regular UK person has super easy way to invest in foreign equities. So,
Absolutely.
but then bonds are striking in the sense that the lines are flat, so it kind of tells you that the story about bonds is somehow different. So there has to be something different about that specific asset class that's
Absolutely.
not applicable to equity. So that's why I find this the combination
Yeah.
of those two figures super interesting. Yeah.
No, I think that's absolutely right. And so fundamentally, bonds are going to be information insensitive. That there's not that much you have to know. Whereas if you're buying all of the equities, now why do I think so? This is the aggregate finding. In defense of the information story, the way you would run is really appealing to the kind of gravity regressions that one could run. And so by that, what I mean is you could write the share of country I's portfolio invested in country J at time t. Let's just say is you could have a source fixed effect, a destination fixed effect, and then a beta for, let's say, distance. There, what you're really going to see is that within the class of foreign securities, you're going to buy stuff that's, like, when I say distance, it's literally miles. Geographically farther from you, you're going to buy less. And you'll see something similar if you do the same language. And so that's the sense in which I totally agree with you on, the cross-section between countries. There it's hard to get the information for the differences between, but within a country's portfolio, I think that's where you actually get essentially the fixed effects are going to absorb the time invariant differences, and then within the country you're going to be identifying this information effect. But teasing those two out is really challenging. And for bonds, I agree. I agree with you. You can make progress, and I think that's what I'm going to show you how you would do actually.
Cool. And there's a question from Sanjay.
Oh, please.
Hi. If we can go back to the previous slide.
Mm-hmm.
So here we can see that the home bias in the euro area bonds has been decreasing, while for the US is pretty much constant and very high. So just out of curiosity, is the reason from the demand side that developing countries demand safe asset from euro area and US, and they consider euro area more safe? Or is it the supply side that the US is supplying more bonds, hence the share hasn't changed, although people, investors are demanding more safe asset from US?
So I'm going to say that's a great question. I don't know. I think that's precisely the kind of research question you can get at with holding data. And so I actually should have flagged this paper earlier, but there's this really great research agenda by Ralph Koijin and Moto Yogo on their demand-based asset pricing. And so they have demand system asset pricing, and they have this paper on, I can't do it, I'm forgetting the title. I think it's their international macro paper using the CPIS data to basically look at the drivers of basically who wants to buy securities where, and they basically look at kind of which characteristics are going to explain that. That question of how you can use trends in the change in asset composition of external portfolios to kind of shine a light on which characteristics are mattering for which investors over time, I view as one of the kind of highest value payoffs of essentially taking this kind of new and increasingly disaggregated cross-border data with their kind of framework on how you would actually discipline an asset pricing model using holdings data. So I can't speculate on, because basically there what you'd be doing is you'd want to take the individual euro area country positions, look at where they're investing, and see if the change in the portfolio within and between the euro areas change over time. So I'm not going to give you a guess, but I think that's the type of thing you can, people have now developed the machinery and we now have the data to actually answer.
Thank you.
Mm-hmm. So this section is really going to be drawing on 2020 paper I have with Matteo Maggiore and Brent Nyman. And the idea of what we do in this paper is, instead of starting with the aggregate data, what we did is and we've been working with for a while now, is we took data from Morningstar, which is just a commercial data provider. You're probably familiar with them, and they're going to give the 1, 2, 3, or 4 stars, 5 stars to your mutual fund. Well, we don't use any of that information. Essentially, what they collect is, for every single mutual fund that they give a rating to, they have the individual security level positions of every single fund. And so what that means is, so most people, when they look at mutual fund investment, their essentially object of analysis is the mutual fund. What we're really doing in this paper, we have, I think we have like one robustness check using the fund level information. What we're really doing is we're basically taking the mutual fund positions of funds based in 10 markets and basically summing them up. And so what that's really going to give us is, this, big component of cross-border portfolio investment for mutual funds in these major developed markets. And so if you go to 2017, we're actually just updating the data to the present right now. You can actually you cover $37 trillion of asset under management, and for many countries, you cover a large share of their external portfolio investment position. And so what that's going to allow us to do is, essentially the conversation I was having with Mike on what's driving home bias. One of the things that we can basically do is say, what are the differences in the characteristics of the bonds that foreigners own versus domestic residents own? How much can a particular characteristic explain these discrepancies? Now, a brief kind of digression of how when I say we work with security level information. So for Morningstar, you basically want to think of what we have is a giant file that says every single mutual fund. So picture like the PIMCO Global Bond Fund. That's going to say PIMCO Global Bond, December 2017 owns these instruments, and they're going to be basically flagged by a security identifier. That can either be the CUSIP, I'm going to say CUSIP, but I could also mean the CUSIP international numbering, the CINS code, or an ISIN. Basically, these security identifiers, which are going to say, for CUSIP, it's going to be this code that maps 1-to-1 with a particular security. So when I see that PIMCO Global Bond has, this particular security, I know that this was issued by the Petrobras International Finance Company. I know that it's dollar denominated. I know it's a 10-year bond that matures in January 2022. And more generally, when you start with security level information, the power that it gives you is that you can essentially merge in any external information that you need. And so, in the aggregate data sets, they're doing a fantastic job of further disaggregating where you can go, but you can't essentially choose the information you need at different splits. When you start with security level data, you can say, I need the currency, I need the maturity, I need the industry, I need the coupon, you can do this with the covenants in there. You have the power to look more finely at what you can do. Now, everything we're going to do here is going to be actually about currency. And so let me kind of show you, just using this Morningstar data, how different the composition of how countries invest at home and abroad is. So what this graph is it's the share of investment in any country I's corporate debt that's in country I's currency. So let me make this kind of more precise here. So let's look at Canada here, okay? So this is 2017. This is saying that when Canada invests in itself, so domestic Canadian bond investment, 95% of it is in Canadian dollars. And across the board, what you see is overwhelmingly, when mutual funds buy the bonds issued by firms based in their home country, it's overwhelmingly in the local currency. So Sweden buys bonds in krona, Euro area investors buy bonds in euros. But what we can do is we can contrast that with how foreigners behave when they invest in each of these countries. And so if we zoom in on Canada now, When foreigners buy Canadian bonds, less than 10% Canadian corporate bonds, less than 10% of them are actually in Canadian dollars. And across the board, what you see is that when foreigners buy the bonds of any given country, they're tilted dramatically away from the local currency, okay? Now, there's gonna be one massive exception to this pattern. And even there, you know, there is a difference, and it's the United States. And so what's really different about the US is, yes, when Americans lend to American firms, it's all in dollars. But when the rest of the world lends to the United States, 75% of that is actually going to be in US dollars. So fundamentally, when American firms borrow from the rest of the world, they're not going to be switching the currency of their issuance. Now, this is an aggregate figure. The power of working with microdata is that you can run a really simple regression that actually is going to zoom in on this. And so what we can do here is we can essentially look at, you know, we can run security by security, how investors in different countries are going to buy the debt of the same firm if they're in different currencies. Okay. So SJPC here, the left-hand side variable. Oh, Edmar.
Is there any other country that fills in somewhere in between the gap, like Switzerland, Japan, or somebody? Does anybody else that have a currency that people like that
so I'm going to show you that Europe used to look like it and lost it. Japan, I actually should have flagged actually. So Japan, we don't observe. So the power of the Morningstar data and mutual fund data generally is that so all of the data I was talking to you about of CPIS, you know, the international investment positions, balance of payments, CDIS, LBS, all of that is about cross-border, right? So when is it easy to measure something? It's when something crosses a border because governments record it. What you can do when you work with mutual fund data is you have a natural benchmark of how much is invested domestically versus what the rest of the world buys. So for Japan, for reasons I'm happy to tell you more about, but basically the Morningstar didn't have the microdata underlying Japan. So we don't have the benchmark of how you know, Japanese invest domestically. We could see you know, how much foreigners invest in yen, but basically the answer is the US looks different than everyone. Europe looked close to the US prior to the global financial crisis and the European sovereign debt crisis. And now Europe is back to looking more like other countries.
But when you say that would look like, do you mean that European countries buying other European countries or outside Euro area?
Outside buying, so foreigners. So there's going to be a few things. When foreigners invest in Europe, prior to the global financial crisis, it was much more of it was in euros. It is now European firms are now financing externally in dollars. And we can actually look at, I'm not going to show this here. I think it's, I'm not going to show this here, but one way you can measure international currency use is we basically did the parallel of, so Gita Gopinath has this great stuff in the international price system for, you know, essentially, and Linda Goldberg too, you know, vehicle currency use. So the Goldberg and Till paper, vehicle currency use in international trade. It's asking the question of how much do foreigners, you know, denominate a good sale in your currency when they import or export something. We can do the parallel for that with asset trade. We can look when excluding the US and Europe, when two countries lend to each other, how much of that is in dollars and euros? And what you see is that there used to be vehicle currency use in asset trade of the euro. So when the UK would invest in Canada, it would buy some euro stuff. That's really been disappearing. And so what you've seen is this big shift away from the international currency use of the euro.
One follow-up thing. So unless I sell you a good and receive like an actual like consumable good and receive the asset directly from you as payment, in a sense, we have to swap currencies anyway, right? So doesn't that mean that if the foreigners don't, if the foreigners like invest in the US in dollars, in a sense, they had to have converted their own assets to sold them to somebody to a US citizen.
No, because you can do a spot transaction in the spot FX market. So this is about like long-term lending. No matter what, if you're selling more than you're buying, you have to buy an asset. Okay. The bilateral pattern of trade imbalances does not in any way have to match the bilateral pattern of international financial investments.
Yeah, I get that, but that's what I'm asking. Like, so suppose I want to buy, I'm a European. I want to buy U.S. assets, U.S. Lend to a U.S. company in dollars. I have euro-denominated assets. I'm going to have to do, like you said, a spot transaction of euros for dollars. Somebody's going to have to get the euros. It's for me to get the dollars, somebody else has to end up holding the euros.
Yeah, but that spot transaction can easily happen. That's the sense in which you still have, anyone has the portfolio choice of, if I want to buy, there's nothing stopping me whatsoever from buying euro-denominated bonds today, even though I don't have any euro-denominated earnings. Now, in equilibrium, the more euro-denominated stuff I buy might move the exchange rate. So kind of the reference I'd have there is, the Gebecks-Majori paper on how those kind of transactions would matter if you have a constrained intermediary. In most frictionless models, that type of spot transaction to buy a currency is going to have no effect whatsoever.
Yeah, I understand. I'm not talking about the effect on the exchange rate. I'm just thinking that, well, you think about, people are willing to lend to U.S. firms in dollars. There's all this activity in the dollar market, but that also means that on net, U.S. investors who would have instead bought those bonds have to be buying euros, and they end up holding a lot more euros. Like you always, unless it's in goods, like you said, and that's much smaller, you always somebody ends up having to, for every dollar that the foreigners holds, the U.S. has to end up holding the euros. So it's just
no, not if corporate issuance adjusts, because it's always a choice of that might be true if you held the stock of assets totally fixed that we're just retrading, but fundamentally the choice of the currency denominated, it's a choice, the currency denomination of debt. So in any given transaction, yes, but one of the things that at least we document is, and I might show a little framework here, is depending on the demand for assets denominated in a given currency, firms have the choice of what to issue them in. And I think you're thinking a lot about the actual exchange of currency. If you're worried about that at all, so one of the ways like Brazil borrows in, there's nothing that says it even has to be settled in a given currency. If I want to borrow in euros and produce a euro-denominated claim, I can easily issue a bond that, where the coupon payment is going to be cash settled in dollars, but the amount that I actually have to pay is linked to the euro-dollar exchange rate. And so the amount I pay is immediately indexed to the euro exchange rate, but it's only dollars changing hands. That's, yeah.
I guess I think I understand everything you're saying, and I guess valuation effects mean that whatever happens today doesn't imply the portfolio composition going forward. But just in a very mechanical way, like this, one way to think about this is people really love U.S. assets. How could we distinguish that based on this from U.S. investors really loving foreign currency?
Because the U.S. owns very little foreign currency.
But that's
when the U.S. invests. So when the U.S. invests abroad, I think I cut the slide that I should have showed you here. When you actually look at the investment abroad, the U.S. owns a tiny amount of foreign currency. When it is buying European corporate bonds, it's now buying European dollar bonds issued by European firms. So it's not as if countries that have more of their liabilities in their own currency have more assets in foreign currency in levels. That doesn't have to happen at all. The U.S.
How do we get to the situation? So on a spot level, just like very mechanically, if I'm a European, I want to go buy some U.S. bonds, I have to find somebody to exchange my euros for dollars, and then I buy dollar bonds, but that means that they end up with the euros, at least at this one transaction, where and for them to originally dollars come from U.S. households. So how did the U.S. not end up holding those foreign currency? Who ends up holding the foreign currency?
Like, you mean from the actual spot transaction?
For example.
I mean, that I don't know where that I wouldn't, I mean, you almost just want to think of it as like a quoting convention of what currency is something quoted in. Like, you could buy a bond denominated in euros with euros or dollars. I don't think it necessarily means that someone is bearing a position in the cash market. I don't think that's not going to be a big, that's just a switching the currency in which you're paying for something.
Okay.
Rather than the long-term assets.
It sounds like some sort of a subtle accounting issue, because I can imagine JP Morgan, right? Because you need some sort of intermediary to buy this euro-denominated bond or dollar. Suppose you're a euro investor, you're buying dollar-denominated bond, so you have to do a spot transaction. So JP Morgan facilitates this transaction, so they end up holding those euros. And then, well, it's American or European bank holding euros. Well, if it's a subsidiary of JP Morgan in Europe, maybe accounting will be that it's still a European entity. So that's what I don't know. But this is in all this kind of data sets that you're talking about, it should pop up somewhere. So if you have a sort of multinational bank transacting in different currencies in different parts of the world, how do they account for this transaction? I think this is what it boils down to, right? Where does it show up in the accounting measures?
Of literally who's bearing the spot risk?
Yeah, who's on the other side in that transaction?
I don't think that's going to be so I mean, I think that in terms of so first, agree here that at the moment we don't have constrained intermediaries. This is, there's nothing that in a world without constrained intermediaries, you can easily have claims in currencies, claims in bonds and currencies without anyone owning, bearing some net position. That you can easily formalize the price that's being paid is in some numeraire, but you're earning a claim that pays off in a different unit of account. Where this does matter, and that's actually why I jumped immediately to the Quebec's majority thing of where this is going to matter is if you actually formalize who's taking the other side of trade between the two. But here, I really want you to think of in the case that, so here, even in a world without intermediaries, imagine that what we have is a French firm issues a bond in US dollars, okay? An American buys that bond in US dollars. The French firm now has dollars in cash, and the American has a claim on a dollar asset. There doesn't have to be intermediation there.
Yeah, that's clear. I think Itamar's question is US company issuing debt in dollars, and then European investor buying this dollar-denominated debt, right? I think that's the issue.
Oh, I see. So in that case, you're just worried about who's making the spot transaction and taking the side of it. So I don't know where that would show up exactly. Yeah. All
right. So we're at about 10:30. If you, I don't want to interrupt you, but if it's a good time to stop for a break.
Actually, this is perfect time to stop for a break.
Yeah. Okay. That's what my feeling was. So let's break until 10:40 Eastern time for 10 minutes. Thank you.
Perfect.
All right, let's get serious.
Excellent. Praveer?
Great. Okay, so I wanted, before we move ahead, I just wanted to, that this bias towards domestic currency, do you think we can rationalize it through risk, the currency, like exchange rate risk, or do we need some other explanations to explain like this much bias which we see in data towards
good question. So I think that, honestly, I think it's an open question. I think that there's already some really nice theory papers that would predict home currency bias. So I'm picturing a nice paper by Charles Engel and then Pierre Levé-Grinchas that basically the idea is that if you have goods sticky in your home currency, your local currency denominated stuff is going to be basically more predictable in terms of consumption, and so you could very much rationalize that. I think, and separating that from information, different perceived risk, I think is challenging. The thing I think that it's actually going to be easier to show, or at least that we're going to focus on showing, is how this moves firm borrowing decision. But yeah, I think that those papers are really nice theory papers that show that you can get this bias.
Awesome. Thank you.
Excellent. So let me jump in. So in terms of how one would use, basically if you want to zoom in so in these aggregate pictures I showed you, okay, we can already see this heterogeneity in currency, and it's it's a strong heterogeneity, but fundamentally, this could be different because the set of bonds, the set of firms that investors are buying are different. Maybe foreign investors are lending to energy companies, and energy companies are issuing in foreign currency, right? Like right now, this is an aggregate pattern. What the microdata on holdings allows you to do is to zoom in and say, are we sure it's actually currency? And the way we're going to do that is we're going to measure basically at the security level. So a security C, so there's a particular bond issued by a particular firm that's held by country J. So this is the share of it. So if Apple issued a bond and Canada owns 10% of it, this would be 0.1, okay? Now, the power of using the microdata comes essentially from the ability to run a firm fixed effect, okay? And the coefficient we're looking at is how much more of a security does an investor own if it's in its own currency. And so essentially in this example, if we fix the firm as Apple and we said that the investor J is Canada, we would basically be asking how much more of a bond do Canadian investors own issued by Apple if it's in Canadian dollars versus US dollars or any other currency. And here, so the controls, we can have maturity and coupon, you put any other bond characteristic you want in. But by looking at the security level data, you can really zoom into the firm level and say, the only thing different between these two bonds is the currency. And so when you run this regression, you can see really stark differences. And so looking at Canada, what this is saying, this coefficient of 0.9, Canada is really small in international capital markets, okay? So Canadians probably own 1% to 2% of the world portfolio. This is saying that if a bond is in Canadian dollars, Canada will own 90% more of it. So if on average Canada owns 1% of everything, it'll own 91% of all bonds issued in Canadian dollars. And this is conditional on within the firm. For the Euro area, Great Britain, the US, and we do the other countries in the paper, you see these really enormous differences. And so because this is within the firm, we can be really confident that we're picking up currency. Now, to tie this back to kind of the giant literature on home bias, using the microdata, you can basically ask the question of, you'd be running a similar regression framework, but considering 3 specifications. You can basically include a home country dummy and ask how much more of a security do you buy if it's in your country, if it's issued by a firm in your country, then alone, just how much more of it do you buy if it's issued in your currency, and then essentially have a home country dummy and a home currency dummy. Now, one of the things that's important to flag here is this is dropping the kind of tight identification of within firm, because country doesn't vary. Country doesn't vary by firm, right? We're going to say that Apple is always an American firm, and so we do have to drop the firm fixed effects here to do this. Okay. Now, running this regression, first only using country indicators. Okay, so this is saying that if a bond is issued by a Canadian firm, Canada will own 49% more of it, and you can across the board see just how strong these effects are. So 37% for Switzerland, 42% for Europe, 22% for the UK, 54% for Sweden, 48% for the US. And you see the huge R squared. So this is a univariate regression at the security level that can explain, between 13% and 50% of the aggregate variation. So, country is enormously important. Now, though, we just look at currency. And what you can see is that uniformly, the effect of currency is stronger. So it's 94% now for Canada, as I showed you, and you can kind of see across the board. Every coefficient goes up, and the R squared is dramatically higher, okay? In the third specification, we're going to include both country and currency indicators. And what you can see is that the country indicator is essentially going to 0, and the currency indicator is relatively unchanged. And so in terms of our conversation about the drivers of home bias, what this is saying is that basically if a American firm and a Canadian firm both issue a bond in Canadian dollars, Canada will own roughly the same amount of it, regardless of the country that it's issued. It's not exactly true. It'll own 3.4% more of this Canadian dollar bond issued by a Canadian firm. But overwhelmingly, this bias in portfolios of investing in your own country is going to be kind of subsumed by investing in bonds denominated in your own currency. Okay. Now, that's the kind of empirical finding of this is how investors allocate their portfolio. But kind of for why this matters, the question is, okay, so what we see is investors are going to buy bond in their own currency. And I didn't show this here, but the only exception is the US dollar, that people have big positions in the dollar. This naturally opens up the question of how is this going to affect the allocation of capital to firms within and across countries. Now, if all that it was a frictionless bond issuance world where a firm wants to raise capital, investors have this preference for their own currency. You issue a bond in a particular currency. If you're a firm, you can swap it back. You can leave the exchange rate risk unhedged, whatever. You can just cater to your different markets, but still raise all the capital you would, okay? But I'm going to show you that that's actually very far from the case. And so first, I want to give you a sense of just how much this heterogeneity in the currency of issuance explains heterogeneity and how much of your financing comes from foreigners, okay? This is the case of Canada. So the x-axis is just saying how much of a firm, the share of a firm's total debt is in Canadian dollars, okay? So over here, this is saying a firm only borrows in Canadian dollars. Oh, sorry, this is saying, sorry, share of a firm's debt in foreign currency. So this is saying that a firm borrows nothing in Canadian dollars, only in foreign currency. Here, they're only borrowing in Canadian dollars. And the y-axis is saying how much of that firm's debt is owned by foreigners. And so what you can basically see is that it's, for Canada, it's on the 45-degree line of if you borrow entirely in foreign currency, you're entirely financed from foreigners. If you borrow entirely in Canadian dollars, you're going to borrow entirely domestically. Okay. Now, across the board, you kind of see this strong 45-degree line, for the EMU and Canada. Now, there are a few things to look at where you can see it's a little bit different for the US. So first, this is a massive density of firms that are only borrowing in dollars. And what's interesting is you actually see that American firms that are borrowing only in dollars are still getting a pretty good chunk of their capital from foreigners. Itamar?
Yeah, it's very interesting. I want to ask you, would it be fair if suppose you did this in stocks, would the following be analogous? If you asked the same thing with taking, let's say ADRs. So if a foreign company issues an ADR in the US, what portion is owned by Americans versus if they issue the, so I don't know how many people here own like Chinese stocks in RMB in China who aren't themselves Chinese. I would guess it's very low, but in ADRs in the US, or issued directly, it would be very high.
There's a great paper by Frank Warnock, and I cannot remember his co-author on this, that shows that home bias disappears for ADRs. But so you're not foreigners. So once you issue an ADR in a US exchange, home bias disappears. The thing that I do think is important though, is just because you have an ADR, it actually doesn't change the payoff on the stock. This is the purchasing is in US dollars, but fundamentally you're still getting a claim in cash flows of, whatever the business is.
Right, that's even better identification in the sense that it seems like it's really about I don't know if it sounds like a fairly minor, but very important friction that for the investors, it's just a pain or difficult, or they don't know how to access it in the foreign currency, not even about the payoff. I mean, what you're saying.
So I think the ADR thing is different. And I think the ADR, I do think the endogeneity of who issues an ADR is going to be the people who want to raise money from, like the selection of the ADRs is big. We're going to do, I think I have this here. We do what I think is actually the cleanest comparison of, is this currency or is this the firm? We basically say, you can basically look at, I'm going to show you that, there's a whole chunk of firms here that, so let's say for Canada, okay? I'll show you this in a couple slides. There's going to be a whole chunk of firms right here who only borrow in Canadian dollars, and the United States doesn't lend to them, okay? I can then match those bonds to the firm's equity and ask the question, do Americans invest in those firms, right? They do. And so that's the sense in which that's as close as we can get to saying it is actually the currency of the security, not necessarily the firm. It's not, because the big thing that we'd be concerned about here is all of these firms that are stuck at zero don't want to borrow foreign capital, right? That there's something about them that don't make them appealing. But I can show you that you'd have to come up with a story where foreigners don't want to lend to them in debt financing, any currency, but they're happy to buy their equity. It's not perfect, but I find that kind of story hard to come up with. We couldn't come up with that.
That's a very good one. What it rules out, which I wouldn't have thought is a great story anyway, but it's like about something, you could imagine people immediately writing models where it's about the payoffs of them and how that like hedges your like labor income or something like that. But you can see the ADR example, this example too, it's really not about that, because they really don't care what it pays off in. It's really about how you access it, how you buy the security.
So that's the thing. I don't know if the ADR is a different set of, so I must admit, I don't have the ADR data on top of my head here because remember, the ADRs are different in it's like the big global firms, right? So it's not that it's going to be a subset, but yes, there's definitely something about you lower the barriers to entry, people buy more of it. But I think the reverse is actually harder of you give, I'll show you what I mean by this actually. So let me show you why the story we have in our head here is actually about something like a fixed cost of borrowing in foreign currency, okay? And so what this is plotting is the number of currencies. So basically for our 4 countries, Canada, the Euro area, Great Britain, and the US, we rank firms by how much they have issued in a given currency. Issued total debt. And on the y-axis, it's how many currencies you borrow, okay? And so what you basically see is, firms that issue more debt are going to have multiple currencies, but it's these small firms over here that really just only issue in Canadian dollars. And so what you basically, at least the argument we make to interpret this, I won't drag everyone through the math here. The way I at least, kind of understand these findings is about investor, segmentation of currency preferences. And so essentially, I'll go through this in a second here, but basically the assumption that we make here based on the empirical results is that bond holdings are really going to only depend on the currency of denomination. That's what investors are going to care about. And so there's going to be specialist investors that are going to be fully segmented by currency. Okay. Now, this currency-specific bond demand.
Sorry, Jason, there is a question.
Oh, please. Oh, sorry about that. Yep.
Yeah. And go ahead.
Hi.
Anna?
You might have said this, but I was just wondering what the time frame of the sample is. This is kind of related to Itamar's question. If we're thinking about motives, does it change? Do we see any stories about motives if we compare earlier periods to later periods in terms of returns or like safety?
So the data is going to cover 2005 to the present. Everything I'm showing you here is actually just a cross-section in 2017. So this is just, this was a purely cross-sectional one. The home currency bias within firm one is going to basically be stable. It's going to basically be stable for the last 20 years. Now, if you, I don't know what you get if you go back to 1980. Positions were just so much smaller that there was very little cross-border portfolio corporate bond investment.
Okay, thank you.
Mm-hmm. So this is a really simple story. I won't actually drag you through the equations, but basically, the formalization, just to kind of set ideas, because I think this is actually something that, going back to the earlier question of like, does it matter why, people want to hold in foreign currency? I have very little to say about this. And I think there's a ton to do. What I'm really talking about is, and what I've kind of focused more on is taking this foreign currency preference as given. What are the implications for how firms borrow? And so kind of the simplest way we kind of formalize why this all matters is essentially saying, what's the interest rate that a firm P pays if it borrows in currency K, okay? We assume there's some risk-free rate. Implicitly, this is the not true assumption anymore that CIP holds between risk-free rates. So one of the things that would now be interesting is immediately, if you're hedging your bonds, you would expect interest rate differentials by currency. But basically, why are currencies different? Because the elasticity of the interest rate with respect to how much you borrow is going to change. So what makes the US special? It's that it's going to have the lowest slope. We basically model it as the more money, the more wealth people want to invest in a given currency, the more you can borrow without having a huge effect on your interest rate. So the thought experiment is, imagine you're IKEA and you're contemplating raising $1 billion of financing. It's arguing that borrowing in the krona, because it's a less liquid market, the more you borrow, the more quickly you're going to increase your interest rate. Whereas because the US has, and the dollar has deep capital markets, you can essentially have a lower slope of the interest rate. Now, in that case, you would basically have a reason to always borrow across countries, across currencies. But the evidence I showed on which firms are actually borrowing in foreign currency really looks like firms are essentially facing a fixed cost of borrowing in foreign currency, that the small firms just don't do it. Now, what would this fixed cost be? Honestly, I think it's an open question. If you think firms are hedging, any of the frictions that would take you into entering the cross-currency swap market or entering into the forward market, a relationship with a broker dealer, posting collateral for these contracts, anything like that is going to lead that. But basically, if you're now a European firm, and the problem we formalized is basically, your capital stock is all going to be debt financed. You have some productivity. Your costs are just going to be your interest rate costs. And potentially you have to pay a fixed cost to borrow in any currency that is not your own. So if you borrow outside of the euro, okay? And so this is basically, all we've done is taken the Mellitz 2003 model of international trade, but instead of paying a fixed cost to export to a given market, what's the advantage of exporting in international trade? It's that you haven't already satiated a given demand curve in another country. So you pay a fixed cost, you face some new demand, and you can essentially sell more goods. We've formalized what's going on with firms as what's the reason to borrow in foreign currency? Because investors are segmented by currency, that if you start borrowing in a foreign currency, you're going to face a different pool of investors. And so you can, by borrowing across multiple currencies, you can essentially lower your all-in interest rate cost. And so firms borrowing in multiple currencies are going to behave as if they face a world interest rate, which is going to be pinned down by the weighted average of the individual currency interest rates. But to give you a sense of like how this would work and how you can kind of rationalize the pattern, the implications of the patterns here, let me just kind of show you in graphs how this would work with a parallel to trade. If we assume that European debt markets basically have a higher interest rate elasticity than the US. So as you borrow more, your interest rate rises faster than if you borrow in dollars. All we can do is plot the productivity of a firm, as a function of how much debt it issues. So European, no matter what, more productive firms, they want to have a higher optimal size, they borrow more, okay? Now, if you borrow in dollars, your optimal size is going to be larger than if you borrow only in euros, essentially because borrowing only in dollars versus borrowing in euros is going to lead to lower interest rate costs for any given scale. What's the advantage of borrowing in multiple currencies? You can essentially get to an even lower interest rate, and so your optimal size is bigger. Now, exactly like in international trade, what are firms going to do? They're going to optimally choose the amount that they borrow to maximize profits. And so European firms are essentially going to face two choices: the euro-only curve or the multi-currency curve, okay? Now, the advantage of borrowing only in euros is you don't have to pay a fixed cost. So what you're going to have is your profits are not going to increase that much with your size because your interest rate costs are going to increase. If you were to borrow in foreign currency, you have a more gradual interest rate schedule, but you have to pay the fixed cost to enter. So which European firms are going to choose to borrow in foreign currency? It's simply when the profits they can make by essentially borrowing multiple currencies are enough to cover that fixed cost, and so you'll have the selection. Now, what's different about the US? Because the US has this deep liquid market, interest rate costs don't rise that much with bond issuance in the US, and so it takes a much larger firm to find it optimal to borrow in multiple currencies. And so this is exactly the graph you would have if you took the Melitz model of international trade and said, how productive does a firm from a large country have to be to find it optimal to pay the fixed cost of exporting versus in a small firm? If you produce in a small country, it doesn't take selling that many goods to satiate the domestic market. And we kind of just formalize a version of that runs parallel to this. Now, I know that was fast. There's no reason you have to follow the equations, but the interpretation is essentially that the US is as the international currency, is going to have this flattest demand curve in the deepest market. And so this is what we think is essentially a quantity reason why you care about being the international currency issuer. Local currency only firms' funding cost is going to be reduced by accessing foreign capital, okay? So there's going to be a couple features here that I'm going to show you some evidence of. That what's the feature of being the international currency issuer? So local currency only firms are going to attract more foreign financing than in other countries. And local currency firms are going to constitute a larger share of total borrowing, okay? And so this is starting to get closer to what Itamar was asking about, kind of building up to it. This is the sense in which it matters that foreigners are going to avoid local currency issuers. So this is a complicated graph, but I think it's the most important one I'm going to show you. So let me walk through this slowly, okay? So this is for all the top 500 largest Canadian firms, okay? On the x-axis, it's the issuer's rank in terms of domestic borrowing. So just how much the firm has issued, how much domestic residents invest in a particular firm. The y-axis is the share of the portfolio, okay? And so in red is the share of the domestic portfolio, and these blue diamonds are the share of the foreign portfolio. So this first firm, I think this is Toronto Dominion Bank, but I may be wrong here. This is saying that the largest, Canadian issuer constitutes 9% of the Canadian bond portfolio in Canada, but only 8% of the foreign bond portfolio in Canada, okay? And so you can see by construction, the red dots are monotonically declining. So that's how much each firm represents in each portfolio, okay? That's for all firms. What the right panel does is it just looks at firms in Canada that have only issued a bond in Canadian dollars. And it asks how big of the domestic portfolio are they versus the foreign portfolio. And so this is saying that, I notice I've changed the axis here. So this is a different firm. There's a firm here, I can't remember which it is, that accounts, it only borrows in Canadian dollars, but it accounts for more than 3.5% of Canada's domestic bond portfolio, but it's essentially missing from the foreign bond portfolio. And so what you see here is there's this huge group of Canadian dollar only borrowers that are just utterly missing from the foreign bond portfolio. Okay. Now, Canada's small, but it's not just Canada. You can do this for local currency issuers in the euro area. There are plenty that take up a big part of the euro area portfolio in itself. They're completely missing in foreigners' investment in Europe. In Great Britain, there's a ton of companies that account for that are pound-only borrowers that are essentially missing from the foreign portfolio. Why is the US so different? Here, when you zoom in on only dollar borrowers, okay? There are plenty of firms that only borrow in US dollars. They not only account for a huge chunk of the Americans' domestic bond portfolio, but here the blue diamonds are essentially a best fit line. So just because a firm is borrowing only in dollars, it's not underweight in the foreign, relatively in the foreign portfolio. And so what makes the US so different is that in every other country, firms have to do something to get foreign capital. They have to borrow in foreign currency. American firms, just by issuing in dollars, are already tapping international capital markets. So it's essentially like being the international currency is opening up the capital account for small firms that don't borrow in foreign currency. Now, this is putting it all together. So this is basically saying, let's look at, if we only look at local currency, firms that issue local currency, basically summing up the red dots and the blue diamonds. For the US, what you can see is, it's not that they're exactly the same. The firms that issue only in dollars are slightly underweight in foreign portfolios, but they're really close. So 60% of the American portfolio is firms that only borrow in dollars, 50% of the foreign portfolio. But for every other country, the gap is just enormous. So you see that, New Zealand dollar borrowers are a massive share of the New Zealand portfolio. They're missing, they're way underweight the foreign one, and similarly for every other country. Okay. Now this is getting to Itamar's question of how do we know these firms this is actually about currency? Let's make this graph for the exact same set of firms. This is for their bond, how they appear in foreigners' bond portfolios. This is the equity, how much the share of foreigners' equity portfolio is in firms that only issue bonds, only issue local currency bonds. And so this is the sense in which it really does look like it's the currency of the bonds themselves and not something about the firms, because when these firms issue equity, foreigners buy it. And so it really does look like there's something about the firm, it really does look like it's about the currency of the bond, not something about the firm.
Jesse, could you go please to the previous chart for just a second? So if we ignore US, there is still some sort of cross-country variation in this blue bars, right? So is there any useful information in that variation?
I think there is.
Why do people prefer issuance in New Zealand dollars, for example, to Australian dollars? It seems like it's the same.
Honestly, I'm puzzled by it. I couldn't tell. So I think that this is something I think there's a paper to be written on that. It could be the relative, just speculating. Is it that the Australia is bigger than New Zealand and Australians buy the New Zealand dollars, or is this a differential carry trade thing? I don't know. But yeah, I agree that we're focusing entirely on US versus everyone else, but there's just a wealth of differences between these. Tyler.
Would it be fair, Jesse, to say that maybe the solution to the allocation puzzle of capital flowing into the United States out of developing markets is being like that puzzle is being explained by this network effect of people wanting to go into the currency. So like there's people want to, you know, invest in a high return place, but there's this fixed cost. And it turns out like the fixed cost of going out of the network is very high for like developing countries. So I'm just trying to piece it together with, you know, that sort of puzzle. And it seems like this is related to that.
I wish we could say this is a solution to the allocation puzzle, but the allocation puzzle holds for more than the US. So, you know, so this is the Grinchas and John paper about how you would expect in a neoclassical growth model that, you know, faster growing countries should get capital inflows that goes the other way. The US part, I think that this type of bias towards the dollar could give you a reason why American firms issue more debt that could filter into you know, the imbalances for the US. But I think that that puzzle is going to be a little bit broader. That you have to go a little bit. Does that make sense though? I'm not sure if that's what you're getting at. Yeah. And so just putting this all together, and fundamentally what you see here is that international currency status is going to affect capital allocation. And so, you know, there's this benefit of being the international currency that essentially makes it easier for your firms to borrow. And one thing that we found pretty striking that you can really see in the aggregate data is the extent to which this really changed just over, you know, the last decade plus. This is looking at the share of cross-border positions in dollars or euros. And you'd really see that, you know, prior to the global financial crisis, it had gotten pretty close. Yet after the global financial crisis and then accelerating at the European sovereign debt crisis, you really see this divergence. This isn't valuation effects. This isn't just US and Europe. You know, there's like a countless number of versions of this, but instead you really do seem to see that the status has changed kind of tremendously over time. And I think that there's, you know, where there's real progress to be made is kind of on the implications for what this means for the firm side. So in terms of, actually, we've talked about a lot of these. And so I think Mike asked a lot of questions on which frictions prevent some firms from borrowing in foreign currency or investors buying it. We specified, in that simple framework I wrote down, you can basically think that it's, you know, some version of currency in the utility function. But it's not taking, you know, it wasn't taking a stand on what's driving this, what's driving the friction, and what's driving the fixed cost at the firm level. That's just something that, you know, there's kind of a wealth of research to be done. And you know, what this is showing is that, you know, these frictions and these preferences change the allocation, but understanding, you know, the implications of this, why this is happening, is pretty open. Similarly, on what we discussed of what's driving in investor currency preferences, is this, you know, information, or is this, you know, kind of an optimal portfolio? I think the real effects of changes in international currency use is something that's, you know, pretty exciting. That you actually do see this divergence here. When you talk about international currency use as being something that just moves kind of the risk-free interest rate by currency, it's kind of very hard to think of coming up with a strategy that actually measures the effect, because it's going to be something that's shared by every firm. Once you have this kind of fixed cost and selection into borrowing in foreign currency, these changes and looking at what it does across the firm size distribution, I think is a big open question. And finally, kind of the biggest question of what are the benefits and risk of dollar hegemony? That, you know, this is something you know, it's going to change the set of firms in the US that are getting capital from foreigners. I think there's a real welfare question of how much is that effect worth to the US, and what are the things to be done to maintain it. Let me pause for questions here before I turn to the last section. Gia?
Yes, so I think all of this talk is for corporate bonds so far. Mm-hmm. And then I wonder whether we can generalize it into sovereign bond market, where like South Korea, for example, they face this international lender where they have favor in their local currency, so that for South Korea, they are thinking of whether issue bond in dollar or local currency or any other currency.
Yep. Absolutely. So this is something I work on quite a bit, actually. And so this is focusing on corporate bonds, but so I guess there's been a few major changes in the sovereign debt market, really also since the Asian financial crisis. So there's this really influential work by Eichen, Green, and Hausman called Original Sin. The idea that the reason why there's macroeconomic instability in many emerging markets is they face the so-called original sin, that they can't borrow in their own currency. What you've seen in this, where we are right now, is that things have changed pretty dramatically in the sovereign debt space, in that what you've really seen is emerging markets switching the currency of their issuance to local currency. Now, what you've seen is, so this is something I've worked on, but it's very hard to actually get to think about the portfolio choice, because hypothetically, if you're, let me see if this works here. Hypothetically, if you are an emerging market, okay, you can choose whether you want to borrow at home, abroad, and in local currency versus foreign currency, okay? Now, where we are is that basically all the issuance is here and here. There's some exceptions that sometimes there will be, so Brazil is a country that does a little bit of local currency issuance. There's some that do home foreign currency issuance, okay? So what you basically see is all of the bonds that are issued in international markets to foreigners tend to be in foreign currency. But what's really changed over the last couple of decades is that foreigners have been essentially, capital controls have come down. Foreigners have been allowed to buy the local currency bond in domestic markets. And so right now, if I want to lend to Peru in Peruvian soles, I have to essentially buy a bond onshore in Peru, and there's some frictions for starting up there. So in terms of what this means, and so basically what you see is that foreigners will buy all of the foreign currency stuff, but they're going to be a subset of investors in the domestic local currency stuff. So essentially, what a government will do is they'll issue a bond domestically, and they'll let markets clear between foreign and domestic. And so tying back to what I've kind of been talking about today, if what the government wants to do is raise capital from foreigners, it can do so with certainty by borrowing in foreign currency. If it chooses to issue in local currency, it's basically going to have some foreigners buy it and some locals buy it. And so in terms of like the drivers of the shift to local currency, a lot of what's happened is that some countries, particularly those most affected by the Asian financial crisis, simply decided they were not going to issue foreign currency bonds anymore. So Thailand, for instance, literally was kicked out of the JP Morgan Emerging Market Bond Index, the dollar-denominated bond index, because it stopped issuing dollars. And so you can think that now foreigners own a bunch of Thai baht currency and local currency bonds. But what is Thailand underweight the Thai sovereign? Is that underweight in foreigners' portfolio? As a share of the global economy? It is. And so essentially what governments really face this trade-off is they can borrow from foreigners in local currency. It tends to, you tend to automatically raise funds from foreigners when they borrow in foreign currency. But you're very much seeing some willingness of foreigners to buy the sovereign. Now, why they're disproportionately more inclined to buy local currency sovereign debt versus local currency corporate debt, to me is actually a pretty big question, and I don't have the answer. Is that what you were getting at?
Yes, exactly. And one follow-up question is, you're saying, so foreign investor, they're now would like to think about buying local currency that is issued in domestic market. Mm-hmm. And what incentive do you think they have to?
So at some point, I mean, so picturing South Korea would have very little dollar debt, right? It has just very little, the sovereign has very little dollar debt. And so any kind of diversification motive to get access to the Korean won, or just to be not underweight the Korean sovereign, the only way to do that is to buy this stuff onshore. Now, that opens up the big question of why governments, to my 2x2, governments have the option, if they ever wanted to issue local currency debt abroad, right? And the Brazilian government actually does some of this. Like the Brazilian government chooses to issue some Brazilian real denominated debt. It actually settles in dollars, but it's real denominated in New York. Okay, that's a way to, to stuff we talked about before. That's a way to immediately lower the barrier to entry of foreign investors buying stuff in your currency, while keeping it denominated in your currency without taking on the exchange rate risk. Governments tend to prefer not to do that. The reason I've heard from governments is they prefer to basically create the most liquid local currency sovereign curve in the hopes that that will encourage firms to borrow in local currency, so they don't want to borrow across multiple markets. That, whether that's big, that's small, I don't know. I don't find that like a completely compelling answer, but I think that that's the sense in which you have these two tools in which to attract foreign financing. If you just want to lower the costs of foreigners investing, you could easily just issue local currency debt in New York, cash settle it in dollars, exempt it from any of the registration requirements you would have to go onshore. Governments don't do that. But I think understanding the incentives of how you can both borrow in your own currency and lower the cost to investors is a pretty big open question in the sovereign debt space.
Right. This is super useful. Thank you.
Of course. Any other questions here? All right, so in the last 40 minutes or so, let me really turn to something that I previewed a lot when talking about how you get started working with, basically international financial data, which is how you deal with tax havens and offshore centers, because they're not a minor inconvenience. Sometimes they're the whole story. And so let me now kind of jump into how this stuff really works and how you can kind of solve it in some way. So let's take the case of Petrobras, the Brazilian oil giant. Okay, you might imagine that when Brazil opens up the capital account and it allows foreign investors to come in, what you'd expect is how Petrobras, and this is actually very related to the last question of onshore markets, you might expect Petrobras to simply issue bonds under its own name, either in New York or locally, and Americans or Europeans would just lend to Petrobras. That's, buy the bonds. When you look in the data, there's just no flows like this. It is next to nothing. Now, that is not to say that Petrobras doesn't raise a whole bunch of money from foreign investors. It's just that they do that through offshore shell companies, financing subsidiaries. So Petrobras International Finance Company, PIFCO, in the Cayman Islands, what it will do is it'll issue a bunch of bonds, and Americans and Europeans will buy these bonds. Similarly, the Netherlands, which, by the way, for security issuance, very much consider a tax haven. Petrobras Global Finance and Petrobras Global Trading, a financing subsidiary of Petrobras, they'll issue bonds. Americans and Europeans will buy this. Now, PIFCO and Petrobras Global Finance and Global Trading, they don't really do anything. These are shell companies and subsidiaries. Okay, so if any of you have retirement accounts, you probably, and you own a emerging market bond fund, you own these bonds. Okay, the reason you own these bonds is you think that you're lending to Petrobras in Brazil. Some of the funds even list it as you're lending to Brazil. Now, we were talking earlier about this distinction of residency versus nationality in international statistics. The way international financial statistics work is they record the location of a transaction based on a residency basis, which means the location of the immediate issuer. So if I'm sitting here in New York and I buy a PIFCO bond, that's going to be recorded as an American investing in the Cayman Islands. If I buy a Petrobras Global Finance bond, that's an American lending to the Netherlands. Now, if you want to think of, as we do, and I think that for most economic applications you want to think that, okay, these are shell companies. It doesn't mean anything that I'm lending to the Caymans. Actually, this is an American lending to Brazil. Then what you're saying is that you want to work on a nationality basis. And what that means is you're ascribing the location of the flow to the location of the controlling entity. Okay. And so what this And what I'm going to show you here is basically how to go about converting data sets and the implication of doing so from a residency to a nationality basis. And so this is joint work with Antonio Coppola and also Brenton Matteo again. But just to give you a sense of, I already showed you those figures for, the Caymans is the equity destination for the US and same for bonds, but tax havens are going to account for more than 10% of all cross-border positions, okay? So 15% of US portfolio holdings are just in the Caymans. Now, the way that a lot of the literature, and honestly me implicitly thinking through of, okay, it's 10 to 15% of these data sets. Can it matter that much if we, kind of drop them in our own empirical work? Now, if you think that all that you need to do when you drop a tax haven is scale up every other country by 10 or 15%, then no, it probably doesn't matter that much. The thing that, kind of the primary finding that I'm going to show you here is that it's not 10 to 15% of everything. It's basically just the whole game for a few major emerging markets, okay? And so it's not that by working with some data on a residency basis and the official data, you're just kind of underweighting everyone by 15%. It's that you're missing a huge chunk of Brazil, Russia, and China. And so it can really distort our understanding of what's going on around the world. And so, this residency versus nationality thing that I've mentioned, just to be clear, it's not that anything in an international market is in a foreign nationality, okay? So basically, you can only change residency and nationality when it's issuance through a subsidiary. So if the Brazilian sovereign issues a bunch of bonds in New York under its own name and Americans buy it, that's residency and nationality Brazil. This is how we think of things. This is how it's supposed to work. Now, I'm also not saying that nationality, where you ascribe location to the ultimate parent, is always better than residency. It really depends on the question. So Toyota Motors North America, if I buy a bond issued by, what is essentially a company producing cars in North America, do I want to think of that as Japan or not? Depends on economic activity versus ultimate control. So it's not clear. Where am I really confident that you don't want to be looking at residency data or that it's not that meaningful? It's when things are going on in a tax haven. So in the example I just said, lending to a foreign shell company in the Cayman Islands, I don't think it's that meaningful to call it the Caymans. Similarly, American firms that tax invert to Ireland, so the example would be Medtronic, they'll move their official headquarters for tax reasons, but they'll still keep producing and selling in the United States. That's just not that meaningful. And so what we've done, and I should say this is, so I'm going to walk you through this in some detail. And one of the reasons I want to do that is everything that I'm going to show you here is available online at globalcapitalалlocation.com, including the algorithm and the algorithm I'm about to show you that does this, and disaggregated cuts of all of this data on a residency and a nationality basis that I kind of hope is useful for your own research. But the key to, so the Petrobras example, you can actually go to Petrobras's annual report, you can find all these bonds and you can do the adjustment. But what we want to do is we want to do this residency to nationality adjustment for every single security in the world. And so we're going to map 27 million securities from a residency basis to a nationality basis. It's basically combining 7 commercial data sets. The way we've written the algorithm, and I should say, if you ever use this for your own research, please feel free to reach out to us. We've spent a lot of time trying to make this usable for PhD students and others to use. And if you're thinking like this would be annoying to ask us about, we're actually hoping to get those emails. And in fact, one of the ways we've tried to make this usable is we know that most universities do not have 7 of these, but you might have some subset of SDC, Capital IQ, maybe Orbis. We've written this aggregation code to run on any subset of this data. More is better, but some is a lot better than nothing. And so what we basically do is the output is going to be this mapping file of where every single security is issued on a residency basis to where it belongs on a nationality basis. So for PIFCO, that would be moving it to Petrobras in Brazil. Gazprom does its borrowing in Luxembourg, we move it to Russia. And essentially the biggest change of, that I'm going to talk quite a bit about, kind of coming back to something in tax havens that's big enough to move a country's net foreign asset position, It's what's going on with China and the Cayman Islands. And so I'll talk about this in detail, but basically to preview a bit here, that Alibaba that's in your Fidelity account is not Alibaba in China. It is Alibaba Group Holdings sitting in the Cayman Islands. And all of that investment that you're making in Alibaba is recorded as going to the Caymans, not China. But just moving that is going to move $400 billion of wealth to China. Now let me pause here. Anyone have any questions here? I know this is some dense stuff. Oh, I see one in the chat of will I discuss the VIE? I'm going to have a bunch on VIEs, so let me actually postpone that one. So this mapping file, in and of itself, I think is useful. What we want to do, though, is essentially that problem I showed you, very early in this class on when you look at the CPIS data, the Coordinated Portfolio Investment Survey data. It looks like all of money, a huge chunk of the money is going to tax havens. What we want to do is essentially restate TIC and CPIS, moving all of that money that I showed you gets recorded as being in the tax havens. I want to move that to countries where economic activity takes place. So that mapping file of where every security is on a residency basis and a nationality basis tells us on an issuance, based on issuance, what that would look like. I think that's important because it's the aggregate, and we posted that online. But to do the holdings, what we do is take the Morningstar data on mutual funds and ETFs. We also have collected the universe of US insurance companies and the Norwegian Sovereign Wealth Fund. And what we do is we essentially merge the security level positions to this mapping file. And we basically then make a representativeness assumption. We say within each year, asset class, and bilateral country pair, these fund holdings are representative of the universe of portfolio investments. Okay, I'll show you precisely what this means. We're able to verify this with the insurance and sovereign wealth fund. But essentially, what we're going to need to do is say, within the set of mutual funds, we can see how much investment in the Caymans actually goes to China. We're going to calculate that number, and we're going to use it to restate the aggregate. And we're going to do that by creating a series of what we call reallocation matrices. And sorry for being a broken record, but these are all online. This is a different matrix for each country, investor country, year, and asset class. Okay. And I think that these are useful for research in and of themselves. But here's the reallocation matrix just for US corporate bonds in 2017. And this is essentially, so the real one, by the way, has 170 countries so that it adds up to 100. I just truncated it to the 6 here so you could see. But these are going to be the answer to the question of what share of investments on each country in a residency basis go to each other country on a nationality basis so that the rows sum to 100. Okay. Now, this is saying when the US invests in Brazil on a residency basis, all of it stays in Brazil. But let's go to the important one, which is going to be the Cayman Islands. Okay. We say that 1.4% of all investments in the Cayman Islands on a residency basis stay in the Cayman Islands on a nationality basis. Okay. If our algorithm was perfect, this should be 0. Nothing happens in the Cayman Islands. Okay. So anything that's invested in the Caymans should be moved. This is saying we're able to move 98.6% of the stuff, which is pretty good. Now, where does it go? This is saying that 20% of it actually goes to Brazil on a nationality basis. So this is the Petrobras International Finance example. Okay. 33% of it goes to China. Now, what's interesting is, and I'm not going to talk about much today, is some of this cross-border investment is what we call spurious foreign investment. That 13% of what's bought in US corporate bonds actually goes right back to the United States. Now, this is actually understating the scale of the issue because I've zoomed in on US corporate bond investments. And so there's a nice paper by Liu and Schmidt-Eisenlohr on this. If you look at all bonds that includes US CLOs, almost all of those collateralized loan obligations are resident in the Cayman Islands. And so whenever an American buys a CLO, it's recorded as a flow to the Caymans. And so this idea of a lot of what these international statistics are going to call cross-border might actually be this kind of round trip. But with this matrix in hand, though, what this is going to let us do is it's basically going to say, if we take the official data on a residency basis, we see how much is invested in the Caymans, We want to move 20% to Brazil, 33% to China, 13 back to the US, and 3.5 to Great Britain. Okay, that's precisely what we do. What you can see in this table. So this is what the Treasury International Capital data, the data underlying CPIS and the balance of payments for the US looks like. So the first column in red is the official TIC data on a residency basis. Here I have two different versions. Both of these are available. Tax haven only means I'm only going to reallocate securities issued in a tax haven. Full nationality says I'm going to move everything to ultimate parent. So the way to think of this is Toyota Motors North America, it's going to be Japanese under full nationality, but it's going to stay American under tax haven only. Okay, and so depending on the question you want to answer or ask, different columns are relevant. Now let's zoom in here on where is the amount of money that's invested increased. So Brazil, China, and Russia are huge changes. So in the official data, the US only invests $8 billion in Brazilian corporates, $3 billion in Chinese corporates, and nothing in Russian corporates. We estimate that this should actually be 50 billion, 47 billion, and 12 billion, because the overwhelming share of investments in these countries' firms are intermediated through tax havens. And so, if money is increasing, where is it coming from? Basically, move all the money out of Bermuda. We move almost all of the money out of the Caymans. We move almost all the money out of Luxembourg. And now Ireland, we wouldn't expect to move all the money out. Whereas I said we succeeded if 100% of the money leaves the Caymans. Of course, that's not the case for Ireland. Ireland has real companies doing real business and people are investing in them. But at the same time, you have a lot of companies issuing their bonds there, for tax purposes. And so, some of this money is going to move out of Ireland. Now, I gave you the US example, as an example, but this is to show you kind of the magnitude of the change. So this is for 9 developed countries. We dropped New Zealand here because the CPIS data was incomplete. In red is what share in the residency data, the official data of the external position of every country gets invested in the BRICS: Brazil, Russia, India, China, South Africa. And in blue is how much we estimate should be, on a nationality basis. You can see it's a big difference. So it's not that the US invests 2% of its portfolio in the BRICS, it's really 7%. You see something similar for the Euro area, and you see big heterogeneity. So Norway, the sovereign wealth fund, tends to avoid tax haven-based investments. And so the adjustment is much smaller. So there is meaningful heterogeneity in this use of tax havens. Just to kind of visualize what this is actually doing. This is for Eurozone bond investments. If you want to think of, we basically estimate that the Eurozone would put another $72 billion in Russia. And this actually used to be larger before the sanctions and the Ukraine invasion. But what you can basically see is that $45 billion of what would be recorded as domestic investment in Luxembourg or investment in Ireland actually is going to Russia. And similarly for China, you could see that when the European, when Euro area investors buy stuff in the British Virgin Islands or the Caymans, it's going to China and also to Brazil. So you can really get a sense of this heterogeneity across countries. Now, do the exact same thing for kind of restatement for equity. And here, let me zoom in on, what are the big changes? Basically, in TIC, in the official data of the US, is say the US only owns $154 billion of Chinese equities. We estimate that this number is actually $700 billion. So this is off by, more than $500 billion of understatement. So, not quite the magnitude of China's investments in treasuries, but getting close. And why is that? It's because mostly the stuff in the Cayman Islands, we also moved some Hong Kong stuff, is actually investments in China. And so let me just give you a sense of this magnitude here. This is how much the official data understates the extent to which large developed markets are exposed to China. So in the case of the US, I flagged when I showed you the TIC data and the CPIS data that, US investment in China was, less than its investment in Taiwan. 2% of its external portfolio. That changes completely. China is now 10% of the US external equity position, with similar increases kind of across countries. So, the extent of exposure to China is just enormously different. And this I want to flag, kind of stepping aside from the paper. I think that the activities of China in tax havens, and at least for me, before I started this project, I had this sense that tax havens were about rich people hiding their wealth. And the extent to which in securities markets over the last 20 years, the story is about this tremendous rise of how issuance in tax havens is dominated by China. I think this is just a massive question. So I'm going to talk a little bit about, or I'm talking quite a bit about VIEs and the aggregate effects. But I think that there is just the scale of this is just so enormous. $2.4 trillion for equity, $600 billion for bonds, and we just don't really have a sense of what's going on. So let me give you a little bit of a sense of what's going on. And this is actually something that you may have followed. I'll kind of connect this a little bit to the news of, because what I want to do here is basically show, kind of tying back to how I opened up of a country's net foreign asset position is kind of the key, driver of international macroeconomic dynamics and the theory and kind of a key state variable. What I want to do now is basically say, okay, we have the underlying microdata. How are we going to use this to figure out what's going on and what's actually driving this, $500 billion of understatement in the official data? Okay. So let me show you how a normal portfolio investment works. So this is buying a stock. Okay. So let's say I am sitting here in New York. I am a foreign shareholder, and I would like to buy a share of Bank of China, the operating company in China that trades in the Shanghai Stock Exchange. I will simply buy it. I can log into my Fidelity account, I can buy it, and I have a claim on Bank of China. For balance of payments accounting, this is an American owning a portfolio asset claim on China. China has a portfolio equity liability to the US. Straightforward. Now, there are going to be a subset of companies for which this transaction is forbidden. So China has a number of restrictions from the Ministry of Commerce where essentially foreigners are not allowed to take equity stakes in strategically important Chinese sectors. So many of these, technology and education companies. So if you're following the news recently, so China has obviously had a lot of crackdowns on Ant Financial, Alibaba, and their commercial tech companies, and also the education sector, the private tutoring companies. These companies are not allowed to take direct equity stakes in, not allowed to receive direct equity stakes from foreign investors. But that's not to say, so what's confusing about that is that many of these companies trade on the New York Stock Exchange and the NASDAQ. So what are you buying? So let's do the example of Alibaba. So what I would call Alibaba on the New York Stock Exchange is the listed company, okay? So this is the BABA that we all know, okay? So in my retirement account,